This is Rogelio Lantigua from the Lantigua team at eXp Realty, bringing you an exclusive update from Realtor.com. So one of the few bright spots in the coronavirus and stock market panic is that mortgage interest rates have fallen to their lowest levels in nearly 50 years. That's lower than during the Great Recession. And that's quite a windfall for home buyers as well as for homeowners hoping to cut down on their monthly loan payments. And yet some are wondering whether rates could go even lower. After all, who wants to leave money on the table? Real estate experts are divided on whether rates will continue to decline. Some believe they'll dip into the low to middle 2% range, and others say rates have already bottomed out. And some believe, since we're in such uncertain times, with a potential recession looming in the way, that there's no telling in which direction rates will head next. Realtor.com's chief economist, Danielle Hale, says that we're in uncharted territory, so you can't look to history as a guide to what could happen. It's hard to predict how mortgage rates will react, and I don't think they'll go up until it's pretty clear we're out of the woods. They might move sideways, or they might go down more slowly. The average 30-year fixed-rate loan was roughly 3.25% as of Thursday, according to Freddie Mac, and this is the lowest it's been since Freddie began tracking mortgage interest rates in 1971. So how much can these lower mortgage rates save buyers and refi seekers? Even a small change can add up quickly. Folks can save about $159 a month this year compared with last year on a 30-year fixed-rate loan for a $300,000 home on which they put 20% down. That's because this time last year, rates were at 4.45%. That's more than a full percentage point higher than this year. And this year's rate can save buyers or homeowners refinancing more than $57,000 over the life of their 30-year mortgage. If the Federal Reserve cuts interest rates again to stave off an economic downturn, rates could go down again. Hale estimates we're about 1/3 of a percentage point away from hitting mortgage rates in the 2% range. And she says, for context, in the last 6 weeks, mortgage rates have come down by that same amount, but I don't think they'll keep moving down quite as quickly. Mortgage applications shot up 54.4% from the previous week and 192.4% compared with a year earlier in the week ending March 6th, according to the most recent data from the Mortgage Bankers Association. Refinances made up the bulk of the applications at 76.5%, up from 66.2% in the prior week and 479.2% from a year ago. Competition is stiff to secure mortgages, particularly refinances. To handle the rush of buyers and homeowners seeking money-saving refinances, some lenders are raising rates. Greg McBride, chief financial analyst at Bankrate.com, says that the obstacle now is lenders are so backlogged, many of them are not putting out competitive rates because they're not looking to acquire additional applications. The mortgage industry was not staffed for this type of influx of applications. The real challenge is, can you get your rate locked and the loan closed before that lock expires, given that backlog? Mortgage lender Don Frommeyer has seen rates tick up slightly to slow down the influx of folks seeking to refinance. His company has hired 4 new underwriters to assess loans just in the past week, nearly doubling the company's number of underwriters. And he believes that rates will continue to fall into the low to middle 2% range, potentially by November, during the run-up to the presidential election. President Donald Trump will likely want to keep the Federal Reserve's short-term interest rates low to stimulate the economy, and mortgage rates are influenced by what happens to federal rates. And mortgage rates are related to the 10-year U.S. Treasury bond market. And when the stock market is volatile, as it has been recently, investors often sink their money into bonds. And when bonds rise, mortgage rates fall. Now the question remains, should folks hold out for even lower mortgage rates? Folks shouldn't wait for rates to fall further to lock in a mortgage rate or refinance. And this is according to Sylvia Gutierrez, a mortgage banker at Impact Mortgage based in Miami. She believes that rates will rise again once the coronavirus panic is over. She says it's not worth the risk to wait and see if they're going to go any lower. Jump. Because I've been in the mortgage business since 1993 and I've never seen them this low. And Gutierrez certainly practices what she preaches. She recently refinanced her mortgage, cutting 12 years off the term of her loan without raising her monthly payments. Her rate was 3.875% on a 30-year loan when she bought her home in December 2018. She refinanced into a 15-year loan with a 2.5% rate. But she advises folks to act quickly, as many lenders are overwhelmed by the surge in business. In addition, keep in mind that rising home prices could offset a little of the mortgage savings for buyers. Prices are already rising at a faster clip. In December, annual list prices were up 3%, according to Realtor.com data. They increased by 3.4% in January and 3.9% in February. Still, there's no question. The lower mortgage rates are a boon to anyone planning to purchase or refinance a home. According to Greg McBride, whether you get a mortgage that starts with a 2 or starts with a 3, 2020 will be a good year for home buyers. This has been Rogelio Lantigua signing off. And from those of us here at the Lantigua team at eXp Realty, if you want more information and more updates on the housing market like this, please consider subscribing to our YouTube channel and clicking the notifications icon so you get every single video as soon as it comes out. Also, make sure to like our Facebook page at eXp Realty Rogelio Lantigua to make sure you get all the latest updates on future listings.